Hi, everyone, and thank you so much for joining our Cherry Bekaert webinar today. We are very pleased to have you with us for this CPE session. Now, we are offering up 1 hour of CPE for this webinar, but we do have some criteria to go through before we get going. So just make sure you answer at least 3 of the 4 polling questions and attend for the full 50 minutes. We will also be sharing a short survey that will be posted inside the meeting chat at the conclusion of this webinar. Now, CPE certificates will be issued via email within 10 days. If after 10 days, anything or received one, please email cbhlearning@cbh.com. A recorded version of this webinar will also be available in about a week. It will be sent via email and posted to our website. Now, if you have any questions during this webinar, please reference that chat window down in the bottom panel of your screen. You can click that window and type any questions you might have throughout the presentation. We do want to note that it's important to keep your mic and video turned off during this presentation. And with that, I am pleased to welcome Sarah McGregor, Director with Cherry Bekaert.
Thank you very much. Welcome today. We are talking about year-end tax planning for individuals and families. Just a quick reminder, this is not a comprehensive review of any development or tax position. This is for education purposes, and please do not rely on this to make decisions. Important tax decisions, talk with your tax advisor, hopefully at Cherry Bekaert, and make sure that your specific facts and circumstances fit with the items that we're talking about. Now, today, we're going to give you an overview of year-end planning and work through some areas. A couple of things about the material we're going to cover. There have been a series of proposed tax laws ready to be signed by the president. It does not have much in the way of tax items in it. The Build Back Better bill that came out of the House is, well, it's still in the House, still waiting to be voted on and then move over to the Senate. It does have some tax impacts that affect individuals, and as a matter of fact, it's still changing. We will touch on a few of those items, but we have focused this webinar on areas of impact that we know are going to happen. We know certain things, certain rules are changing from 2020 to 2021, and then may also have some changes already planned for 2022. So we're going to concentrate on the things we know are actual, and on occasions mention some of the proposals that are in the Build Back Better bill to bring to your attention as well. So with that, I've got 2 colleagues here today, John Urey and Tyler Wilson. Both work in our high net worth with high net worth individuals and also estate, gift, and trust areas. And so they're going to be our key speakers today talking through these items. So John, let's start with kind of an overview of tax planning and sort of the roadmap we go through every year when we start talking about year-end planning.
Yeah, thanks, Sarah. And welcome, everyone. Glad you could join us today. So quickly, first few slides here, we're going to just walk through some of the typical year-end planning items that we like to go through. Right at the top there, we've got defer income. Obviously, if we can defer income to 2022, we don't have to pay tax on it until 2023 potentially. So if we can't avoid the income, we'd like to defer it. Same with accelerating deductions. Want to pay as many of those deductions, the expenses as we can this year that are deductible, as long as our cash flow allows for that, so that we can potentially mitigate our tax liability at the end of the year. If you have some losses that can be harvested, we can generate those to match potential gains. We also look at the classification of our income, ordinary income versus capital income, and the differences in those tax rates, and then also passive versus active income, also potentially different, taxed differently, and also any losses that we have carried forward, address those different types of income differently also. We can review the basis of the S Corp stock and partnership interest. As we'll go through later in this presentation, there are now 4 steps we have to walk through to be able to determine if a loss that's flowing through a passive entity, if we can actually take that on an individual 1040 return. So we'll look at that. We'll assess the impact of a 163J limit to the business interest expense. If we have gains through the year, we can look at deferring that gain by investing in a qualified opportunity zone fund. Not for everyone, but at least look at that option. Consider like-kind exchanges under 1031 for real property transactions. We can maximize retirement savings plans, maximize those contributions. Calculate the potential of a 199A deduction as we receive a new business client, especially, or an individual. Many times we'll look at that calculation to see if that's been done properly or even claimed at all. And that's a lot of times an area that we can either amend returns or going forward claim those deductions that have not been claimed in the past. Assess a potential impact of AMT or net investment income tax on the return on liabilities. Claim tax credits, especially with the COVID responses. There are several credits that are available that we could look at. Evaluate the impact of the 2022 income tax on actions that we do in 2021, including potentially keeping our ear close to the ground on some potential tax changes that are going through through Congress right now. Suggest actions individual can take to reduce a 2021 tax bill. That's kind of the overarching message on these. We can confirm year-to-date withholding and also estimated tax payments, potentially correcting or adjusting that Q4 payment that's due January 15th based on what's happened throughout the year. And also eliminate surprises April 15th. Ideally, we're coming within the safe harbor, so we're paying what we need to avoid penalties and interest with the IRS, and then we can calculate what our tax burden, if any, will be on April 15th. So quick roadmap we walk through. Now, as we get into 2021 planning, we really want to talk about what has happened that may change your tax position from last year to this year, from 2020 to 2021. Typically, those are life changes that may have occurred, whether you were married or divorced, or if you retired, if you moved or changed jobs, if you have new children, babies that were born or adopted, or kids that have graduated from college and potentially are no longer counted as dependents on your return. Also, significant transactions that may have occurred during the year. We want to look at the new investments that you may have gotten into, any inheritances you've received, and if any potential tax consequences to those, or even tax planning, casualty losses, and then a successful business that's growing, and the issues that accompany that growth, or even unfortunately failure. What happens if your business is failing or has failed, and the tax ramifications there. We look at how much capital gain or loss you can take before year end. How does that impact your tax liability this year, and does it make sense to do that, as we mentioned earlier? Charitable contributions have become a planning option in the last couple of years, using qualified funds that we can use to bunch deductions this year or next year and get over the standard deduction hurdle, so we can itemize deductions every other year or every third year using a bunch charitable contribution that we'll talk about a little bit later. Income that's coming or losses coming from a pass-through business, a lot of opportunities there, a lot of things that may be missed or overlooked that we want to look at. And then overall, how does your income change in 2022?
So as we come up to our first polling question, John, frequently people say, well, should I take income this year or next year? My feeling frequently is I'll deal with, or should I defer deductions? Sometimes my answer is, let's deal with this year and get the best tax answer we can. And then let's plan for next year and get the best tax answer we can next year. Why pay taxes before we need to? But it's always a question to go through and look at those transitions between years.
Right. And even especially this year, as we're looking at potential changes, potential increases in our tax rates, whether that's capital gains or ordinary income rates. A lot of people are asking, do we want to defer income to next year? Maybe you have a bonus that's coming in. Do I want to pay tax on that now, given that it's probably going to be lower rates this year, or do I want to defer that as we normally would until next year? And that's, as you know, that's an individual decision based on the individual tax situation. There's a little bit of guesswork involved. Still, even now, they're constantly changing the tax legislation that's going through Congress. Just the other day, they added 2,000 more pages overnight that we weren't expecting. So that's an individual decision, but I think it's something we look at, especially this year with the changes coming through.
And modeling. So
Right.
our polling question, which has now closed, how often do you engage in year-end tax planning? And 60% of you said every year. So that's great news. And others, when there's a significant transaction or event that happens. That's why we like to ask those questions, has there been a significant event or otherwise? So great, let's move forward with talking about things that are specific to 2021. Let's talk about some tax laws and things that came into play here in 2021.
Right. So one of the bigger things we'll talk about is the American Rescue Plan, or ARPA, as it's known. This gave us the refundable tax credits, that the $1,400 that were received earlier this year. This is similar to the economic impact payments that were that came in through the CARES Act. This is $1,400 per single taxpayer, so $2,800 for joint filers, and then an additional $1,400 per dependent. There's phase outs that are associated with this rebate that came through. Basically, if your income, if it's under $18,000 for single level, $120,000 for head of household, or $160,000 for married filing joint, then you would be eligible for these deductions, or sorry, for these rebates. This is based on AGI, so just a gross income. But the phase outs really begin around $75,000 to $80,000 of adjusted gross income for single filers, and then about $150,000 to $160,000 for joint filers. So that the threshold there is where you start to see that phase out. If you did not receive those rebates for 2021, potentially could have been because your income based on your 2020 tax return, or maybe even 2019 tax return, deemed you ineligible. So when you file your 2021 return, if your income is in fact lower and below those thresholds, then potentially you could claim the rebates as a refund on your 2021 tax return. Another item that was adjusted was a child tax credit. It increased the credit to $3,000 per child, or $3,600 for children under the age of 6. And this credit was already $2,000 before it was adjusted under ARPA, and they kept the bifurcation between the two adjustments for phase out purposes. So the existing base credit of $2,000 per child, that was reduced by $50 per $1,000 of modified adjusted gross income over $400,000 for married filing joint, or $200,000 for other filers. The additional $1,000 to get to $3,000, or in the case of a child under 6, $1,600. That's phased out for $50 for every $1,000 of modified adjusted gross income over $150,000 for married filing joint, and then $112 for head of household, and $75,000 for other filers. So this additional credit, bottom line, the additional credit gets phased out much sooner than the original $2,000. So it's still there, but it does get phased out sooner. It's also expanded to 17-year-olds, and now they are eligible for the credit, fully refundable. So if you can claim that as a refund. And then some people have noticed that those payments started coming in July. 50% of that projected credit is being paid out month to month. And depending on your tax situation, again, this may be something that is beneficial to you or your clients, or maybe it is not. And so it's something that you want to look at and you can opt out of, but just be aware that that is a credit that would be adjusted on your tax return, potentially adjusting your refund or your liability at the end of 2021.
And this is an area that in the Build Back Better bill would be in the increased tax credit, this child tax credit up to $3,000 and $3,600 would continue for 1 year more in 2022, as well as the monthly payments would continue also.
Right. Yep. Good. Great point. Other things adjusted under ARPA or the child and dependent care. Just for 2021, this increases the credit. So it's up to 50% of qualified expenses instead of 35%, which it was before. And then the phase out begins when AGI exceeds 125,000. And that credit rate, after you get past 183,000, that credit of 50% is then reduced to 20%. So kind of a two-step phase out for that credit. Employer provided assistance. It increases the annual exclusion to 10,500 for married and filing jointly, and then half of that for single filers. This is a program that allowed an exclusion from gross income for employees for amounts incurred by employees for dependent care. This is often referred to as a cafeteria plan and as a dependent care flexible spending arrangement that pays or reimburses qualified dependent care expenses that the employee incurs. So that was increased as part of this plan also. COBRA health coverage subsidies. This ARPA adjusted some of the provisions of this subsidy. So no premiums are due between April and September of 2021 through September 2021. And you're eligible due to involuntary termination or an involuntary reduction of hours. But this new law basically extends the period to opt into COVID coverage for individuals who had this involuntary reduction of hours or termination during the last 18 months. But you have to opt in to be able to be eligible to continue coverage through COBRA through your employer, and the employer gets reimbursed for this cost from the government. So it's a multi-step process, but you have to opt in. It's a good opportunity for those that qualify. And then student loan debt. So ARPA did not discharge any student loan debt. It doesn't have any provisions that forgive student loans, but it anticipates student loan forgiveness by saying that any student loan that is forgiven, and potentially future legislation, that if it is forgiven, then from 2021 through 2026, that debt would not be taxed, because typically under the Internal Revenue Code, if you are forgiven a debt, the IRS treats it as income that you've received, which can be very difficult to pay that tax liability if it's a large amount of forgiveness. And so ARPA says if we have student loan forgiveness in the next 5 years, it will not be taxable to those individuals. CARES Act, just briefly, we'll talk about the excess business loss limitation. This applies again from 2021 through 2025. This applies to taxpayers other than corporations, and provides the provision limits the amount of business deductions that can offset non-business income. The limitation for 2018 was 250,000, and joint returns is 500,000, and these threshold amounts have been indexed for inflation. So under this 461 through the CARES Act, what it does is, as 21, we need to remember that this limitation is now in effect, because the CARES Act, it was supposed to begin at the end of 2017. And when when everything started happening with COVID, the CARES Act kicked in and reduced the effect of this until 2021. So now for the current year, the index limitation is 262 or 524,000 for a joint return. And so the net business losses in excess of this amount will be disallowed on 2021 filings. So just something to keep in mind as you're going through. If you have a business and you have losses coming through, and this last bullet on the slide is helpful because in order to take a loss for a pass-through entity, it now must pass through 4 thresholds. First, you must have stock and basis. You must have some basis in the entity to take the loss. You have to go through the at-risk limitation calculation to determine if, again, that loss can flow through. Past activity losses are in place, and now the fourth is excess business loss limitation, is the fourth tier that you have to pass through in order to determine if any of those pass-through entity losses can be applied to your individual return.
Great. And I'll add another alert that the excess business loss, this 461L loss limitation, is currently set to expire under the TCJA rule at the end of 2025. However, if the Build Back Better bill passes as it currently stands, it would make this a permanent provision of the code. And so it would continue on past into 2026 and for later years.
Right. Further complicating this issue. NOLs, net operating losses. Prior to the Tax Cuts and Jobs Act, or the TCJA, also known as tax reform that happened at the end of 2017, an NOL deduction previously could be carried back for 2 years and forward 20 years. Under the TCJA, the carryback rule was eliminated, and it could be carried forward then indefinitely. The TCJA also limited the NOL deduction so they could apply only up to 80% of your taxable income. Earlier, it could wipe out all of your income for the year. So those adjustments were made for TCJA. The CARES Act temporarily reinstated a carryback period for all NOLs generated after 2017. So really for 18, 19, and 20. And so you could have carried back any NOLs for 5 years through the CARES Act for 18, 19, and 20. For 2021, now those NOLs are only going to be able to be carried forward. But the elections that you made on your 2020 return determine if your 18, 19, and 20 NOLs are carried back first, or if they can now only be carried forward. So if you have NOLs, it's important to pay attention to when those NOLs were generated, what year, and then also what election was made on your 2020 return to determine if you can carry those back, if you have to carry those back, or if you have to carry those forward only. State and local tax planning, this especially is relevant in 2021, also was relevant in 2020, but it's the impact on Nexus, because a lot of us telecommuted during 2021. So if where we live and where we work are different, then potentially we want to look at what's happening with our withholding and payroll taxes. And for example, I sit in Maryland right now. I live in Virginia. So potentially where I live and where I work are different. And what we want to look at is if the states that receive the taxpayers' income tax withholding, if that's the state that actually should have that withholding and where we need to file. There's potentially area for one state to receive the withholding, but it actually should have been received by another state. And getting ahead of those issues now is going to be very helpful. The other issue on this slide, that the last bullet there, is pass-through entity level taxation. Since the TCJA was enacted, it put a $10,000 cap on state and local taxes, as many of us know, where it wasn't there before. Since then, many states have run themselves ragged trying to do a runaround to try to increase this cap. The IRS has shot down lots of options over and over. However, recently they have approved a situation where if you have a pass-through entity, the pass-through entity in that state can pay the income tax for your benefit in that state. That is a deduct. That's the IRS has said that can be a deduction on the entity return, but you can receive credit for it on your individual return. So the difference there is that you're making a run around that cap, so the business can take the deduction that you couldn't take on your own individual return. So there's 20 states that offer the programs. Are all a little bit different, but they're something you want to look into. In this area, I sit, as I mentioned, in Maryland and DC and Virginia. Maryland has that tax provision. Several up and down the coast, and then several out west and down south have made that. So they're kind of spread out all over the 20 that have made those opportunities. So look at those. Even for, I had a client who modest income, and this in Maryland enacted at the end of 2020, right at the end. So we're kind of scrambling to get things done. And so we had him make a payment through his entity for his individual return. He's the only owner of his pass-through entity. And when we filed his tax return, he really didn't understand what was happening. And we were able to show him, there's a $4,000 savings that he made on just very, a modest income. But so there's some power behind using these pass-through entity level taxation programs offered at the state level.
Right, but they're not all they're not the same, as you mentioned, John, and they each have different elections and options, and not every owner of a pass-through entity will be treated similarly. So if you're a resident living in Maryland and the business is operating in Maryland, you may have a great result from this having the pass-through entity, the partnership, the S corporation, pay the tax itself. But if you're in DC or Virginia, you might not get, if you're a resident of DC and Virginia with that Maryland company, you might not get the same results. And multiply that by 50 states, and it can be very complicated to figure out what is the right answer for those. But if you're invested in a pass-through entity, you're active in a pass-through entity, it's a trader business, and throws off income, you may ask about this. Has that business looked into the election to pay tax at the entity level to help you as the individual lower your own state income tax so that you could get some deduction value through the entity rather than having it limited as an itemized deduction on your own return?
Right. A lot of ambiguity there. And I would also add that maybe your pass-through entity is making that election, and it may not be beneficial for you to have that election made on your behalf. So again, we want to be proactive and make sure that we know what's happening and potentially elect out or not elect to have that if it will negatively impact you. So virtual currency and non-fungible tokens. This is the largest source of revenue in this infrastructure bill because it increases the enforcement of collecting tax on the cryptocurrency transactions. So there's no new reporting requirements right now, but the 1040 does ask taxpayers to declare if they have engaged in cryptocurrency transactions during the year. And it's important to collect this information as soon as possible because this is a changing part of the tax code. The IRS, recently has gotten on board and recognized this currency as income potentially. So it's important to be on top and understand. When I found some people it's kind of like a hobby. They invest in cryptocurrency and they don't really pay attention to it. And they might do a couple of transactions and not think anything's really happening. They kind of treat it as monopoly money, but the IRS, those days are over for the IRS. So they're paying attention and they want to have certain disclosures on this currency.
All right, that brings us to our next polling question. We'll get that up there. So do you know someone receiving the advance payments of the child tax credit, yourself or someone in your family or someone that you work with or know? that's getting those monthly payments. Seeing as how the income thresholds for phase out are set fairly high for the base credit, I think a lot of people are getting those that were surprised to receive a check when they first started making the monthly payments. All right, I think we'll have just a bit more to go on that. Those questions in there. So a lot of activity happening at the state levels this year, even if we don't have a ton of activity happening at the federal level. On there. All right, we've got the poll showing that hey, a good 50% of you do know someone who is receiving that monthly check. So far more than I thought we might see today. So great. All right. So Tyler Wilson is in our Nashville office and spends his time too working with high net worth individuals and estate gift and trust questions. So Tyler, talk to us about the nuts and bolts of getting into tax planning and some of the decisions and activities that individuals can take.
Yeah, thanks, Sarah. I appreciate y'all joining us today. So let's start off with deferring income. So when possible, delay or defer compensation, particularly those who have bonuses, and maybe even if you have control over the timing and amount of those bonuses, something to look at year end to see if we should be taking that in this year or possibly deferring it out into the future. This next one, maximizing retirement plan contributions. You're going to hear me say this a few times over my time today, but that's because it's important. It's one of the lowest lying fruits in income tax planning. You get to save money for the future and pay less tax now. So it's really important. Each time I talk about it, I'll kind of give you a little bit more information, but just wanted to emphasize the importance of that. Take advantage of installment sales and like-kind exchanges. If you have a gain event happening in the future, see if there's some options available. Perhaps there's ways to defer that gain into the future or spread out that income recognition over a number of years. So something to look at if you have a sale event happening in the future. Defer gains by investing in opportunity zones. They're still a thing. You can invest by December 31st to claim a 10% increase in your basis by 2026. This next one is about tax location. So if you've got investments that are income generating, maybe they spin off a lot of dividends or cap gain distributions, perhaps those income producing investments are better off in your tax deferred or your tax-free retirement plans rather than in your taxable brokerage accounts. So your accounts that you're getting 1099s for and that they show up on your 1040 return. Perhaps in your taxable brokerage account, you have non-dividend paying stocks or tax exempt investments. Just managing where your investments are held is an important tool in income tax planning. Minimize distributions from your taxable retirement plans. Maybe you're taking a little bit too much out of your retirement plans right now. Maybe it's pushing you into a higher tax bracket. It's something to take a look at year end to make sure it's not harming you by just taking that little bit extra out of your retirement plans this time. And then those of you with stock options, just managing the timing and the method that you're exercising those in is another thing to take into consideration during planning time, just to make sure that you're not, again, harming yourself by doing it at the wrong time. Next up is managing the classification of income. So just knowing the differentiation between capital gain preferential rates versus your ordinary income tax rates is important to know. So let's go through a couple of those topics. So for dividends, just taking a look at your allocation of ordinary versus qualified dividends. So if you have a large portion of your overall dividends as ordinary, those are getting taxed at your ordinary income tax rates. And so shooting for more qualified dividends versus ordinary is a better way to go. Those qualified dividends are taxed at the lower capital gain rates. So if it possible, maybe it's something to talk with your advisor about, just to see if we can do some reallocating and get more of those overall dividends in the qualified nature versus ordinary. Another thing to keep in mind is the 1-year hold period for your capital gains. Up until a year, if you were to go sell an asset, the gains on that asset, capital asset, would be short-term capital gains, which are taxed at ordinary income rates. But once you reach the 1-year threshold, it turns into long-term cap gains, which are taxed at your preferential rates. So definitely something to keep in mind. You don't want to be selling all your investments at 11 months and when you just had to wait 1 more to get those preferential rates. As John said earlier, if you have some gains that you already know that you have this year, look to see if you have some losses to harvest to kind of match or even offset some of those gains, just so you can pay less tax at year end. If you are in a loss position, $3,000 of your capital losses could be used against your ordinary income, and then anything above the 3,000 would be carried forward into future years. And then if you have any carried interest investments, just remember that to receive the long-term cap gain treatment on those assets, you'll actually need to hold them for a 3-year period. So it is a different holding period for those carried interest investments. And then the last thing that we like for clients to keep in mind is just the nature of your intent and use of your property. So there's, is this an asset held for personal use? Is it held for investment, trade, or business? Just knowing this is important to kind of keep in mind, because when you go to sell assets, the way you hold those could determine the way that the gain is recognized and the income generated off those assets is recognized. Some reminders here with your retirement income planning. With the Secure Act that was passed in late 2019, there were some changes to retirement income. So no age limit for contributions on your traditional IRAs now. So if you're an older individual and still have some earned income, you still can contribute to a traditional IRA. And then they also changed the required minimum distribution age. It's now 72. So as long as you were not 70 and a half at the start of 2020, your new RMD age is 72. Now at year end is a good time to think about doing a Roth conversion, paying the tax now and getting your retirement assets growing tax-free into the future is a consideration right now. Again, you got to pay the tax now, but converting those to Roth dollars could be a powerful tool depending on where you are in the brackets towards year end. Here it is again, contributing the maximum amount to your retirement accounts. The one thing I'll add here is those of you that have access to a 457 plan and also access to a 401k plan, they don't share the same contribution bucket. So you're actually able to contribute up to the maximum $19,500 to each the 457 and your 401k. So for those of you that are lucky enough to have access to both, you can do a lot of good retirement plan contributions by contributing the maximum to both of those accounts. For your 2020 coronavirus related distributions, consider paying the tax or actually returning the amounts you took out to the plan before year end. You might have had some hardships towards the beginning of 2020 and decided to take a distribution from your retirement account. And now you might be regretting that decision. You actually have a chance to put that amount back into the account, and we can go back, amend your 2020 return for which you paid tax on that distribution, amend the return, get the tax refunded, and keep those dollars growing in your retirement accounts into the future. And then lastly, a reminder about qualified charitable distributions. This is a great way to satisfy your RMDs for the year, your requirement minimum distributions. This qualified charitable distribution is $100,000 per individual, up to $100,000, and it satisfies your RMD requirement. It's not considered an itemized deduction, so you can actually still take the standard deduction and it comes right off the top out of your taxable income. So it's a great option for those that are at least 70 and a half.
Great. And a couple of Build Back Better provisions related to IRAs are in the November 5 version of the bill. One is that it would eliminate backdoor Roths, that is money contributed, a non-deductible contribution into a traditional IRA that is then converted to a Roth IRA. That would end at the end of 2021 as the legislation is currently proposed. This converting a traditional Roth which is full of pre-tax dollars to Roth and paying the tax now would be allowed for the next 10 years and then it would be eliminated. So I think they're looking at that as a revenue raiser by putting an end date on the ability to make those conversions and encouraging folks to make those conversions early. Something to think about if you have for those that have a super large IRA and are thinking about converting to Roth, remember that the Build Back Better bill has also some proposed surtaxes on high income levels that could come into play. So another area to think about when it comes to these provisions.
Great, thanks, Sarah. Next up, accelerating above the line deductions. So for those of you that had a Schedule C on your 1040 return to report business income, now is a great time just to review with your tax advisor to make sure you're picking up all the business expenses that you're entitled to. So just doing a review, and I know things have changed with coronavirus. A lot of people are working from home, but there still are some business expenses to be had. And so doing a review at year end is a great way to maybe pick up some extra deductions. Again, max out those retirement accounts. My extra tidbit of information here is that for those of you that do have a W-2 job and you're contributing to 401k, but maybe you have a side business or have some additional income that is reported on Schedule C, perhaps it's director fees or something like that, you are still able to maybe set up a SEP IRA account and put some more dollars towards retirement, utilizing that Schedule C income and getting an extra deduction for your tax return. A reminder about net operating losses, they are allowed to be carried forward, and yeah, we can keep going, sir. Managing your below the line deductions, push or pulling your discretionary deductions, medical expenses, charitable contributions into the best year is a thing that we'll advise at year end. We'll go through a bunching strategy here in a couple slides that kind of shows that in action. Reminder about credit cards that when you do charge the expense, that is the year that it will be deductible. So if you have some expenses that are close to year end, and you can use your credit card and get them into the previous tax year. Medical expenses, the deduction floor is 7.5% of your adjusted gross income. So anything above 7.5% of your AGI, that'll be the amount that is deductible as an itemized deduction. Home testing for COVID-19 is an eligible medical expense. For the SALT cap, consider if the $10,000 limit is reached already, whether you should defer that payment into the next tax year if you're already at the limit. This is especially important because the Build Better Back plan is proposing to maybe up the SALT deduction limitation. So if you've already reached the 10,000, it probably is a good idea to try to defer those tax payments into the next year, just in case the limit is raised. And then over there are your standard deduction increases for 2021, married filing jointly, 25,100, head of household, 18,800, and then all other filers, 12,550. Charitable contribution reminders. 2021 limit for most cash contributions is 100% of AGI again. This does need to be cash contributions, and it has to be to qualifying public charities. The big limitation there is donor advised funds do not count for getting the 100% of AGI limit. Just a quick planning note, if you are someone with charitable contribution carryovers, there is some opportunity there to utilize this 100% of AGI. So discuss that with your tax advisor if you do have some carryovers from prior years. There is a $300 above the line deduction for each spouse this year. Last year it was limited to just $300, but this year it is for each spouse, so a total of $600 for married filing jointly. And that is above the line, so it's not even considered an itemized deduction. So just an extra incentive to give some cash away before year end to your favorite charity. And then to donate appreciated property. Great consideration rate there is because you might as well donate the property, say it's appreciated stock, donate the stock to charity instead. You get the full fair market value as a charitable deduction, and you don't have to sell it and then recognize the capital gain and then just give them cash. Well, you might as well just give them the stock instead and get the full benefit without having to recognize the capital gains on the asset. And then for your big dollar amounts, consider donor advised funds or charitable remainder trusts, where you can get a lot of bang for your buck. Charitable remainder trusts, you can donate money. Well, you can give money into a trust, get a big upfront charitable deduction, and secure an income stream over the term of the trust, whether it be a term of years or your lifetime. But it's a way, if you possibly have a big income event in 2021, a charitable remainder trust is a good option to kind of get a big upfront deduction to kind of offset that major income event. And so let's go through that bunching strategy that I mentioned earlier. So consider taxpayers or married filing joint return. They live in Florida with the following deductions: state and local tax deduction of $8,000, mortgage interest of $4,000, and then charitable contributions of $15,000. So they are going to itemize. They'll have $27,000 of deductions, which is greater than the $25,100 standard deduction. So if they were to do that over a 2-year period, that would give you a total deduction of $54,000. But let's say they bunch their charitable contributions into 2021. So they accelerate their charity $30,000 within 1 year, still get the state and local tax, mortgage interest. That gives them total itemized deductions of $42,000 in the first year. And then in the second year, yeah, they're not itemizing, but they still get that big standard deduction, which gives them a total deduction over 2 years of $67,100. So you could see a pretty large difference by just doing this standard bunching strategy, which even if you're a taxpayer in the 24% bracket, that gives you about $3,000 of extra money in your pocket by just doing a bunching strategy. So pretty powerful stuff. And that goes to show just how big the standard deduction is nowadays, that it offers a big incentive to do a bunching strategy. Withholding estimated tax payments. This is crucial to get a good read on this for your year-end planning. We'll review your year-to-date withholding and estimated tax already paid, and then consider if we need to adjust your fourth quarter payment to avoid underpayment penalties or getting a big overpayment in April of 2022. If you are someone that does have a required minimum distribution, a good strategy is kind of to adjust your withholding on some of your later payments in the year. The IRS does consider withholding on retirement distribution as made throughout the whole tax year. So kind of like your W-2 withholding. So it's a good way to kind of catch up if you do have an RMD requirement. And just a reminder that doing projections, doing good projections at year end can eliminate long times for refunds, which has become even more prevalent with the IRS delays lately. And it can also eliminate penalties and interest for any amounts due at tax time.
Great. All right. This brings us to our third polling question of the day. Which would you prefer? I'm interested in your thoughts on this. A small balance due at April 15th, a bit of a refund, or just hang on, I don't want to pay until I absolutely have to. So push that large balance out to April 15th. I'll just pay, once a year, or not quite sure. You'll take whatever comes up. Give us a thought on that. So, John, as always, we'll have about 10 minutes left to talk about estate, gift, and trust. So there's so many good things to talk about at year end when we get there. And Tyler, you made a good point there at the end about making sure that we pay in the right amounts and not leave ourselves open, because the IRS has been so far behind. And if we get another major tax law change at the end of this year, it could really push the IRS again. And they're just digging out from a government shutdown and a pandemic shutdown and lots of tax law changes that they've had to implement and take care of, which really slowed down their ability to execute on refund claims, to handle things, penalties and notices very efficiently. And so it will be nice to do our part to keep our money in our pockets rather than trying to get it back from the IRS or particularly owe them as well. All right, I think we're just about done with everybody weighing in on that poll. And it looks like most of you would be okay with a small balance due at April 15th. And if you have others of you are in the, I want some money back, let me win at this game of paying taxes. All right, well, let's go forward and talk a little bit about gifting, John, and why that's super important as a tool for estate planning.
Oh yeah, I'm gonna continue on.
Oh, sorry, Tyler. Sorry.
Yeah, so gifts to individuals in 2021, the lifetime exclusion is up at $11.7 million in 2021. This is scheduled to expire in the end of 2025. So still a good time, no matter what the tax law change is happening right now, still a good time to do some planning, because it is scheduled to decrease back down to its previous levels in the end of 2025. The annual exclusion amount is $15,000 per donee, and that's per donor. So for your married individuals, you could give up to $30,000 per donee and stay within the annual exclusion amounts and not dig into your lifetime exclusion. Now is a great time at year end to just review your current and future goals. Consider any life events that are happening, marriages, divorces, descendants changing, family dynamics changing. Now is a great time to just take a lay of the land and see if any changes need to be made.
Since I was invited to, I might just say one thing real quick. As you all know, there was a lot of estate gift and trust changes built into the proposed tax legislation, and it kind of lit a fire under a lot of people to get some changes done to their estate tax returns, or sorry, estate tax plans, estate planning. Those provisions are no longer in the proposed tax legislation, but I think, as Tyler mentioned, it's important to continue working towards the estate plan, to continue using up the maximum lifetime exemption amounts, exclusion amounts, while we still have them, because I think those options are still on the table. I think future legislation could take that away, and then, as Tyler mentioned, at least by 2025, that exclusion limit is gone. So
right, and if you guys will forgive me, I'm going to skip forward to this slide because I think this is really important as we're sort of summing up and talking about what are the big things that can make a big impact on planning.
Absolutely. So now, as I said, is a great time to refresh your estate plan, accelerate transfers now. Lifetime exclusion is at an all-time high. The one thing that people are fairly confident in is the lifetime exclusion is not going to go up anytime soon. It's widely considered that we are at an all-time high right now, and it's a great time to maybe accelerate some transfers while it is still at the high levels. Review trust documents that are 10 years or older. Do they still accomplish what they were meant to at the time when you made them? Things change, life events change, tax law changes, Some of the IRA provisions for trusts changed with the Secure Act, where now they might not make sense because the requirement minimum distributions changed on inherited IRAs. So reviewing those IRA beneficiaries and trust provisions is really important right now, just to make sure they make sense, because a lot of things got outdated with some of the recent tax law changes. Consider turning off grantor trust powers. So if you're someone with grantor trusts where you pay the income tax on the income generated by that trust, maybe review whether it's time to turn off those powers, kind of like a light switch. There's some legal light switches where you might be able to turn those grantor powers off and change what taxpayer is paying the taxes on that income. So whether it be the trust itself or maybe the beneficiaries, there are some options there if it's time for the grantor to stop paying the tax. Make charitable contributions with trusts. We kind of briefly mentioned the charitable remainder trust earlier, but explore options as far as income tax planning, cash flow planning, and charitable planning in relation to trust. There's a lot of different types of those charitable trusts, and have a lot of great outcomes for those that are maybe looking for a big tax reduction or a way to stretch out the income recognition of appreciated assets. So something to bring up with your tax advisor at year end. Know your tax basis. Strategies for deferring tax gains start with understanding what the basis is, because based on that and the differential between the sales price, that gives you the gain that you're working with. So every strategy starts with knowing what you're working with, and then consider converting your traditional IRA assets into a Roth right now. Is it a good time to pay tax now and get some tax-free dollars working into the future? Now could be a good time to start considering it.
All right, that brings us to our fourth and final polling question. Would you take advantage of any of these action steps that Tyler just highlighted for us on there? And as we do that, John, I'll go ahead and ask about what do you think on the Build Back Better bill? What sort of questions are you hearing from clients, things that they want us to model or work on?
Yeah, good question. And it's changing so much that we're getting a lot of different feedback. I think we can generally count on the tax rates increasing. So we're looking at each individual client situation, depending on what their income for 2022 will be, what they think it will be for 2021, and making determinations based on those numbers of how to proceed. I think as we talked about briefly, the IRA backdoor to a Roth option currently would be off the table in the future. So that's something to consider now. And then, really, I think now is a great time to take a holistic look at your finances, your estate plan, just kind of everything, and say, do we want to make any changes before this next tax legislation goes through? It's a great idea just to be up to date on those items anyway, but just taking a step back, looking at your investments, looking at your estate plan, looking at income taxes now and next few years, and just mapping out a plan will really help you answer some of the questions that we're going through at this year-end planning.
Great. All right. Well, I think that brings us to the end of our presentation. I think you can see that we have a nice spread of where people might see some opportunities for taking advantage of some tax planning or some just family planning all together on that piece of it. As you know, we do have a number of tax law changes. There's a lot being talked about in the news. If you have something that we can assist you or your own tax advisor to model or project or plan for, we're certainly here and available to help. Again, I thank John and Tyler for their presentation today and their thoughtful comments. And I thank you all participants for joining us and being part of this presentation. So thank you very much. If you have any questions, please reach out to us.